Let's get into it. I'll give a quick background on myself and Consero. I've been with Consero for over 3 years now, since 2020, and I've been a go-to-market operator within fintech and tech-enabled service companies since 2012. As our managing director here, I oversee all of our channel partner relationships and focus on go-to-market strategy, and from time to time help out with webinars like this. As far as Consero goes, founded in 2006 by Scott Tynes and Bill Klein, the original intention behind Consero was to create a modern alternative to building a fully in-house finance and accounting team. Since then, we've expanded our breadth of services and have a variety of offerings, which I'll share a little bit more about. But globally, over 2,400 employees and over 300 clients. The primary end markets that we serve, it's going to be software, business services, and then healthcare service sectors. We also do have dedicated verticals focused on investment manager solutions. And then we also help nonprofits with their back office finance and accounting. But as far as the offerings go, we cover the full office of the CFO. It's everything from fractional and project-based advisory services all the way to a comprehensive finance as a service or FAS solution. Starting with advisory services, we've really just put together a great bench of advisors who can come in. They have experience working specifically with private equity and venture capital backed companies and can deliver really flexible expertise that's tailored and unique to each client situation. In addition to advisory, we also provide what we call flex finance. That's essentially a scalable back office team that can come in and supplement an existing team or take on an entire month-end close. We can support companies that are in any cloud-based general ledger on our flex finance offering. So QuickBooks, NetSuite, Sage Intacct, those are the most common ones. And then last but not least, finance as a service. That's really a full optimization of people, process, and technology. We come in the first 30 to 90 days of an engagement, and we do a full finance transformation, optimize everything. This is typical post-investment by private equity or venture capital. We get companies to a Fortune 500 level finance and accounting function, and then we do it all very quickly, as I mentioned, but also in an optimized cost structure that's generally 30 to 40% better than if a company were to go in-house. But that's enough about the offerings. Let's get into the meat of the conversation here. All of our panelists are experienced private equity and venture operators and investors. So we have with us David Acharya, Managing Director of Acharya Capital Partners, Jennifer Mabe, CFO and Board Director, and also Leon Chen, Managing Partner at Kayne Capital Partners. So, panelists, please share a little bit more about yourselves and your backgrounds with the audience, starting with David, please.
Sure. Well, thank you, Tony, and thanks to the Consero team for inviting me to be part of this panel. My name is David Acharya. I'm managing partner of Acharya Capital Partners. We are a New York City based middle market focused private equity firm. We invest primarily in three industries: TMT, business marketing services, and light manufacturing. Spent more than 25 years on Wall Street, working in various firms first as an investment banker, but spent most of my career now on the investing side. And what's unique about our funding situation is we don't have a committed fund. We do work with a network of family offices and ultra high net worth individuals on a day-to-day basis. And the big advantage that we have under that structure is we don't have a predetermined exit strategy that institutional funds have. So that's a big plus when we are dealing with small companies. And really looking forward to having a robust conversation. Thank you, Tony.
Thanks, David. Jennifer?
Sure. Thanks, Tony and Consero, for having us today. My name is Jennifer Mabe. I am a CFO, typically for private equity-backed SaaS companies, usually founder-led, middle market. I am usually brought in after the organization has secured their first institutional investment to help the company professionalize their finance function. I'm usually working with founder CEOs who haven't necessarily worked with a board or with investors. And so this is a topic that's near and dear to my heart.
Awesome. Leon?
Hey everyone, thank you Consero and thank you audience for joining. My name is Leon Chen. I'm a managing partner at Kayne Anderson. I help lead the growth capital strategy. So we focus on growth stage technology businesses, typically ranging anywhere from 10 to 50 million in revenue. And we partner with them, provide capital either through equity or credit, usually somewhere in the range of 10 to $50 million in terms of capital. And most commonly in a non-control holdings. So, we are very focused on companies that have addressed major pain points and oftentimes older or sleepy industries that have been slow to technology adoption. We provide capital, but I think more importantly, and as we've seen the technology environment evolve, is really bringing to bear for companies at that growth stage the resources and access to operators, vendors, growth stage experts to really help companies achieve or overcome hurdles as they get to the next stage of their evolution. So we really like to play at a stage of growth where we help professionalize the organizations, help bring thought matter or subject matter experts to the table and get them to a position where they can now take on a more meaningful private equity or a strategic acquisition at some point. So thanks everyone.
Panelists, we really appreciate you all taking time for this today. Let's get into the first question. We'll be directing some of these questions towards individuals, but also some of them we're looking for input from everyone. So this first question will be one of those, but I'll ask David to answer it first. So David, what are some of the key challenges to effectively maintain productive partnerships between CFOs and investors?
So out of everyone at the C-level suite, the one executive that has to be an absolute truth teller is the CFO. Okay, and typically CFOs by nature tend to be very conservative, tend to be very risk focused, and so the challenge really is making sure that they balance the needs of the investor versus balancing the needs of the company. And sometimes that may not necessarily align. It should, but not necessarily align. And why doesn't it align? Well, sometimes it's spending related, sometimes entering into new markets, sometimes it is hiring more people, and sometimes it's de-investing in certain areas that the investor group may have value for versus it may not necessarily be politically very popular inside. So the CFO role has to balance both the short term as well as the long term goals, and transparency is absolute key in this.
Jennifer,
what's your take from the CFO standpoint?
Yeah, I agree with everything that David said. I would add that it's a challenge and also imperative to establish an environment of trust, transparency, alignment, collaboration, and you have to do that fairly quickly because you're hitting the ground running. You need to start achieving the goals that have been set forth, right, in the strategy. And you're trying to establish that environment of trust and transparency when you have distributed workforces, you're in different time zones, and everyone's just incredibly busy. So you have to kind of get a little creative sometimes, I think, in how you make that happen.
Yeah, I agree with everything that David and Jennifer said. I think the only thing I would add to that is just in today's environment, I think we're seeing cap tables that are a little bit more complex than they might have been 5-10 years ago. And so you may have stakeholders at various different investment stages of the business and various different incentives. And so whether you have a venture and then a growth or a private equity investor in the mix, they may have different priorities or expectations as to what they want the outcome of their investments to look like. And oftentimes, and especially in today's environment, it's critical. Yes, it's a role of the CEO, but also in many cases the CFO, to be able to bring to the table the conversations around the business challenges that the company is facing, how they're going to achieve that, but also then work closely with each of their major stakeholders to understand and help align where the company is going, ideally into a position where everyone can be satisfied. So
Great insights. Yeah, and just having worked with a lot of CFOs during my time here at Consero, I could say all of that is true. You need to build that trust, work with your stakeholders, balance the needs of the investors and the company, and yeah, the reality is that doesn't always align. One of the things that could help make that process easier, what we've seen is just timely and accurate financials. So Jennifer, this question is for you. What are some of the methods for CFOs to provide their investors with timely and accurate financials, and organizational updates? What are some of the keys there, as far as transmitting that information over?
Sure. So I think you have your good financial hygiene and cadence and reporting in your KPIs or table stakes, right? As a CFO. So that's an expectation that your investors are going to come to the table with. So outside of that, how do you provide them better, more timely information? I spoke about building the trust with the investor. I would hearken that to building a relationship with them. So just like you're going to build relationships with your ELT, with your own financial team, you need to be building that relationship with your investor, so that it's not unusual for me to pick up the phone and call the managing partner or call a counterpart at the investor firm and have a conversation. And then when we do have to have those tough conversations, then you've already established that relationship. When I call up and say, hey, we're going to have a problem with this debt covenant, what are we going to do? Let's work together. It's not unusual for me to be having an interaction with them, right? Some other things that I have seen where this has worked well is with an investor group who had regular working sessions with the operational teams at the Portco, meaning we had monthly working sessions with sales and marketing, with customer success, with the tech teams, and with finance. And it was outside of our more formal board reporting structure and more of an informal working session. And we were able to share timely information that way, because by the time you get to the board meeting, some of that information is stale, right? Depending on when you have when you have those scheduled. And so the way that worked itself as a value to us was that when we set our agenda for the board meetings, everyone already had all of the KPIs, they had the financial reporting, we were on the same playing field. And so we were able to leverage that board meeting time to pick 2 to 3 strategic topics and then do a deep dive into those, leveraging the information that we already had at hand. And we're able to make informed decisions that would drive enterprise value. And that was one thing that I saw worked really well.
Yeah, I agree, Jennifer. As a private equity investor, every CFO has a dotted line to the board. Now, yes, the CFO reports to the CEO. The CEO is on the board, or typically, reports to the board. But I make it very clear to the CEO that the CFO has a dotted line to the board, and we require regular reporting, monthly reporting on the P&Ls, on the balance sheet. We require weekly working capital report, just cash on balance, how much capacity we have under a lending facility, and just basic working capital accounts. We also will ask for certain dashboards and KPIs on a monthly basis to be given to us. But I would also wouldn't underestimate the value that digital tools plays with your communication with the board. And one is a lot of private equity firms have relationships with IT firms that work with the portfolio companies to upload financial data, so we can do comparisons across multiple portfolio companies, and also the use of how you communicate with your board. And the easiest way is email. But the easiest way for information to get missed, okay, whether it was on purpose or not, is by email. So we require our CFO to communicate to us via an investor portal. So we expect all the monthly reports, all the weekly reports to be updated to the investor portal, the monthly covenant testing sheet to be updated to the investor portal. It sets a discipline. It also sets the moment of where, okay, the CFO is busy with multiple things. The last thing he or she is worried about is sending this one particular report, but having that investor portal handy makes it a lot more feasible. And then there's also tailored reporting. You ask for certain things, but in certain industries, there's certain, ratios or metrics you want to take a look at. I'm a little old-fashioned. I ask for a cash conversion cycle. And if you ask a lot of bankers and private equity folks, the last time they did a cash conversion cycle metric was their FSA class doing undergrad or grad school. But that's something that I've asked for, and that's something that's typically not asked at a board level because how old-fashioned it is. And then also just being proactive. If you want to build a great relationship with your board, reach out. Reach out with just good news, and also reach out and be transparent and saying, listen, we're having an issue here. Would love to get your thoughts on it, how to solve things, because as a board, my responsibility as an investor is to make sure we generate a great return and things run smoothly, and any tools and processes that I can offer to make their job easier at the portfolio company will benefit the investment and the investors.
Some great insights. It's easy to say, but picking up the phone goes a long way, and not waiting until there's a fire to make that call to your investors. Critical. I love the investor portal, building that discipline. Speaking of financial discipline and diligence, let's move over to Leon. What level of diligence from a finance perspective are you doing when you're making investments? And are there certain KPIs that you're looking for from a portfolio company CFO, if it's an investment in an existing portfolio company, or if it's a brand new company and they have a CFO? What are some of those expectations you have from a KPI perspective, a financial diligence perspective?
Yeah, so because we invest at a range of companies that are at the low end 10 million or so in revenue, at the high end potentially up to 100 million, the expectations can vary. We understand that when you're growing your business, there's going to be multiple priorities in terms of what you're focused on, and across multiple different business functions, whether that's technology or operations or finance. And so oftentimes we will see, especially at that lower end of the spectrum, finance being a bit more reactionary than proactive in terms of how the team is built out and also how the reporting occurs. And so we certainly level set our expectations as to the level of sophistication that a company may have around their internal KPIs. But I think the more important element is how they view that on a go-forward basis throughout our investment. KPIs at the end of the day, you can track countless different metrics, but the most important ones are ultimately going to be the major levers of what's driving value for your business, and the ability to make informed decisions when there are opportunities to start taking swings at growth opportunities is really critical. At the end of the day, in many cases, there, when you're in a technology space with volatile markets and so many unknowns, what's really critical is being able to pin down the knowable elements of what your business is and what's driving it. And so being able to extract the most valuable data from your own internal operations oftentimes can help refine and improve your decision making processes going forward. And many companies starting out, a lot of more of those bets they're taking are based on leaps of faith, and that mindset does have to change over time as your company grows and scales. And so I really think about the audience of KPIs is three different buckets. It's more than that, but three buckets I see. One is internal. So it's how are you driving your business decisions? What is the CFO responsibility in terms of collecting information either from their product teams, from their sales teams? How are they informing their CEO, and how are they making decisions using that data to drive outcomes? The next piece is then the audience of the board and the investor base. Because ultimately, when proposals are coming to the board, whether it's we want to invest in M&A, we want to invest in a new product line, we want to grow internationally, the ability for the board to provide meaningful feedback in terms of what they're comfortable with, what they support, what they don't, really stems from how do we view the opportunity, how do we measure risk, how do we measure reward, what is it going to take, how does it impact our cash balance and our financials. And having a more robust understanding of the drivers of your business and how that relates to the eventual, typically unknown outcome, but being able to provide informed perspectives of that is really critical. And then the last piece, which is coming back to your point, which is how important is it in diligence? I mean, the short answer is it's incredibly important, especially as you continue to grow and scale your business. I think the expectations of an investor have only continued to evolve, and we are not in the scenario we were 3 years ago, where in many cases, companies would get a pass in terms of their abilities to articulate and substantiate their growth story and the narrative behind that. Today, I think the expectations of having a refined set of information that's really going to answer and tied to the narrative of what your goals are is really critical. And if you don't have the metrics or the data to back up your statements that $1 invested is going to turn into $3 down the road, during a diligence process, that story could easily fall apart. So I think the role of a CFO to evolve their abilities to refine the key metrics is really critical.
Yeah, important to start building that ROI muscle, even at the earlier stages, especially in this environment, which I'm glad you brought up. And that takes us back over to Jennifer. So question for you, Jennifer, just around the current economic backdrop, right? We've seen a historic rise in interest rates. It's been a tougher environment for companies to raise funding. There's a valuation mismatch in many cases where investors think it's worth one thing, and sometimes the companies are pegged to the 2021 valuations. What changes have you noticed in the investor CFO dynamic there, or are there any areas where you felt like there was a disconnect between you and your investors based on just the current economic backdrop?
Yeah, I'm not sure I'd say necessarily changes, Tony, but certainly, as Leon said, there is a heightened attention being paid to the data. You have to have the strong KPIs, the strong metrics, the strong SaaS reporting to help tell the narrative of the company and make strong decisions going forward. I will say, navigating this economy, I've seen CFOs lean more into the investor relationship and leverage the strong ties that the investors have to the banking community. Typically, they have your stronger relationship with the lenders. And if you need to take on a new debt facility, renegotiate your covenants, make some sort of change to the debt agreement, it's helpful to be able to lean into those relationships that the investors have. Some of the private equity groups have CFO summits, and it's very helpful to get together for a couple of days with your colleagues from the other portfolio companies and share best practices. And some of those private equity groups also have their own operating teams in-house. And so being able to lean into that for special projects or to bounce off of them, again, best practices, how the other portfolio companies are managing different scenarios is certainly very helpful.
Absolutely. David, I want to come back to you. You were mentioning earlier how, right, sometimes, the company needs and the investor needs are a bit different. Thinking about that in long-term value creation, how do you ensure some of the, the financial strategy aligns interests, between investors and that the company's actual needs at the point in time?
It is, so I see this a lot in corporate America. CFO, when they talk to investors, they have a different message. When they talk to employees, they have a different message, and they emphasize other things. And I always say you have to have the same message to every party. Now, you can emphasize certain things that affect that party versus other parties, but sometimes I hear totally different messages to me, and then I'll listen into like an employee webinar, and I hear a totally different message there. Okay, so it's critical to make sure that the message to the employees, to us, to our external debt factors are all the same. Okay, and that just comes down to, transparent communication, the most critical success factor for us investors to track the company's financial health, the performance, the risks, the growth, the growth prospects. Something as simple as, let's take risk assessment. We as private equity folks, we love to hear the words recurring revenue. Okay, when you hear the term recurring revenue from a company, you think that it is, oh, you have a customer that says, hey, for the next 2 years, I'm going to buy X amount of services for both years. Then you go to the data room and you look at the customer contract, and it's really an MSA, a master service agreement. And the difference is, well, it doesn't outline how much money or how much product or service that the customer has, but there is an inward where the customer has already approved the company to be the provider of that service. And if you think about it, it's a lot different from a risk perspective of recurring revenue versus an MSA contract. Now, it is usually up to the CFO internally who's tasked to communicate this, and so that's extremely important. Sometimes when you see revenues go up like 10%, like, oh, revenue's gone up 10%. Then we find out that all the revenue for that month was generated by one salesperson. Well, the risk assessment to that investment has changed quite a bit, and you have to make sure you keep that person, very happy. Strategic direction is the CEO and the CFO have to be aligned on this, okay? Because the CEO is entrusted to execute on that direction, but it's the CFO who provides discipline and makes sure the bills get paid and the revenue gets collected, okay? And you have to make sure they're on board with that. One of the challenges with lower middle market companies, the CFOs may not necessarily have the experience of working with an investor group. They typically work for an entrepreneur or a family, or maybe a small company that never really placed emphasis on long-term direction. So, those factors are very key in terms of the transparent communication that we want from the CFO and why it's so important to the board.
Highly fascinating insights, David. I realize we only have 15 minutes through this, so I do want to bring back Allison to go through some of the audience questions. And I have some more questions. If we have time, we'll get to them, but we want to make sure the audience gets to ask their questions.
Great. Thank you, Tony. So I think this would be a good one for Jennifer. What advice would you give to a new executive moving into their first CFO role?
Question. Communication is incredibly important, as you've heard us repeat throughout the webinar. And I think what David said is even more important, making sure you have the same messaging, but knowing your audience, having your executive presence when you're in a board meeting and understanding how you communicate to your board. It's the same message, but how you communicate at a board level is different than how you're going to communicate with your finance team, which may be more granular, right? Where your board level may be more strategic. So communication is key, making sure that you're aligned with your CEO, with your board, and everyone is in clear agreement on the strategic objectives of the organization. And then being really strong in your KPIs and your reporting and your metrics and your data.
I would just add too, I think we have certainly been in situations where we've had first-time CFOs join the executive suite. And I think one critical element is, not to be a hero and admit or recognize where you may not have expertise. And, I've had some of the best CFOs we've had have been those that have come to us and said, hey, we need bench strength, or I need advice as to whether it's, I've never done a refinance before, I don't know what banks to reach out to. I don't know what pricing looks like. Can you provide some insight? In some cases, it's, help with my KPIs. Do you have a CFO mentor or some coach on your bench that you can bring to bear so I can start thinking about, how specifically I can start building out our internal models within our organization. I think that level of humbleness, and it comes on both sides. It's also on the investor to have their expectations managed and work with the CFO to help block and tackle some of those elements. But I think being able to recognize that and be transparent is critical, such that there are no surprises at the end of the day.
That's great advice. Thank you. For each of you, what is a skill set that you gained early in your career that you still leverage now? And what is an area or skill set you had to let go of to be successful? Oh, David, did you want to tackle that one first?
That's yeah. So I think the first skill set I use from day one is analytical skills. The model building, how to value a company, how to go through a P&L in granular detail. I still use it now, even though 25 years later, it's expected that a junior person is supposed to do that work. But I think a very successful private equity investor, no matter how senior you are, you need to get dirty with the numbers. So the analytical skills. The other skill, and quite frankly, it took me some time to develop this, is public speaking. Okay, and you are going to be dealing with various constituents when you're at the senior level, and it's important for you to articulate the right message. If I was going to rise, was that I had to be comfortable in communicating, and not just among a small crowd, but of course in front of a large group of people. Okay, but the one skill set that it was hard for me to give up, I had to learn to give up, was you also have to delegate. Okay, you can't do everything. Okay, when you have 50 contracts in a data room, you have to delegate it to somebody who can go through that and then review it and have the confidence that you can make those types of decisions, because you have somebody doing the analysis, but ultimately you're making the money decision as the partner on the deal, and that's a hard part. That's a hard thing for me personally to have given up. But I think the ability for you to delegate appropriately and provide the right oversight is a skill set that I had to learn to give up.
Great, thank you. Any additional thoughts on that, Jennifer or Leon?
I'd say leaning into your leadership skills, David talked a little bit about delegating. Certainly part of being a leader, you have to step back as an individual contributor and understand you can't necessarily control everything and do it yourself. You are now the leader of a finance team of an organization if you are acting as a enterprise wide CFO, and understanding that your job now is to build high performing teams and manage not just that as a finance level, but across an executive team and your board, and learning how to manage multiple competing priorities and having excellent time management skills.
Yeah, I would say on that point, I mean, having some level of mental agility or flexibility is critical, whether you're an investor or a CFO or just, leadership at the executive level. When you're growing a business and you're in technology, you're going to have so many different elements coming at you at any given time, and being able to flip between a conversation at the board, then working with your internal team. On my end, it's talking to a CEO, then being in a model, and then talking to a new company. I mean, those are all very different, oftentimes very different skill sets, and being able to switch across those is important. And then I would also just add intellectual curiosity. As an investor, always pushing myself in terms of what I don't know and what I could learn is important. And I think from a CFO, the role of a CFO 10, 15 years ago is very different than what it looks like today. And the complexities of the business, the complexity of the industries are ever growing. And so not just sitting within what is your defined scope of work, but also pushing the bounds of where things could get better, I think is a critical element for ultimately growing in a profession.
Thank you. I really appreciate your insight on that question. And another one that came in, what are some methods to keep the board focused on strategic value added discussion versus going too deep on topics that can often derail a board meeting?
I can start with that one. It does tie to one of the earlier points, and I've seen this before. And I think it's really important to find balance, because it can be a temptation for the board or the investor base to get too in the weeds. And as a result of that, oftentimes stymies the ability to actually provide, the strategic guidance that's critical. I will say typically when I see the board getting into the weeds, it's often because a challenge is proposed or a notion is proposed that is not particularly well informed. So if the commentary is, hey, I'd like to go and make this acquisition of this business. We think it's a good deal. It's, X EBITDA and it's growing X, Y, and Z. Can we do it? With no other context behind that, naturally the board or investors groups will say, why is this strategic to us? How does it fit onto our roadmap? Is this accretive or dilutive to our valuation today? Will it be down the road? What are the synergies? There's all sorts of questions that stem from that. So really getting ahead of what is potential questions that the board may ask creates more confidence in the board that the elements of the different dynamics that are required have been thought through. And once they have that confidence that those elements are thought through, then it's really more about, how does the landscape look? What is the, competitive set? Like some of the bigger questions that they should be asking, rather than, have you validated this with your product team that you can integrate? Or have you validated this with your sales organization that, they can upsell this product, right? Or whatever ends up being. I think a lot of getting ahead of that and answering those questions. And oftentimes what I see is before it comes to the board or before it comes to the, at a more formal level, CFOs or CEOs will get ahead of it. So there may be conversations 1 week before, 1 month before, sometimes, quarters before, around this is what we're thinking about. This is what we want to do. Therefore, when you get to the conversation at the board level, it's not, hey, out of nowhere, we're doing X, Y, and Z. It's, you remember when we talked about that at the beginning of the year, where our 3 or 4 key initiatives were X, Y, and Z. This is an example of one of them. This is why we've thought through this already. And therefore, again, it's a lot less about, the more tactical questions. It's much more about, okay, how does this fit into that plan that we had previously previewed with you? So.
Yeah, Allison, I agree with Leon. I mean, I look at, my experience on the board and certain scenarios when something was, quote unquote, springed on us at the board, didn't go far. But when something was, I would say, pre-discussed prior to the board meeting, it would go far. CEO, CFO would call me and it's like, we're looking at this acquisition. We think it's very strategic based upon this. We've done some preliminary work on it. We think the numbers are accurate. We think from a cultural perspective, it could be pretty easy to integrate or not as hard as we think it is. And then, by the way, we're also aligned because the CEO wants to join, the CEO/owner wants to join a larger platform. And that makes the conversation a lot easier at the board level. It also gives confidence from the board to the management team that, hey, these people are really thinking about the company, thinking about growing the company, versus, okay, they want to do a bunch of acquisitions and they propose it at a board meeting. And the first thing that's going through my mind is, okay, they're trying to hide something that is at the company, and an acquisition can help clear that all up. So that pre-discussion prior to a board meeting will go a long way in getting the idea implemented. So whether it's an acquisition or or some kind of new strategic direction with customers, products, or services. So it's as simple as calling somebody up prior to a board meeting, but you'd be surprised on how many executive teams don't do that.
I would agree completely with both David and Leon. There should never be any surprises at the board meeting. That is not the place to have those discussions for the first time. I would also touch on something David said earlier about public speaking, how you carry yourself as the CFO, your executive presence, the confidence that you inspire in the board meeting is incredibly important. And I've seen this sitting across the table now as a board member myself. When you have a CFO who comes in who doesn't necessarily inspire confidence, who can't answer the questions, who doesn't have the data to back it up, you start making your board members nervous, and then they're going to start asking more and more detailed questions and dive into the data further and further to try and get the answers they want, because you aren't inspiring confidence by your executive presence.
Thank you. Well, I think we're just about out of time. So I want to thank David, Leon, and Jennifer, and Tony for being here today. This was a really great discussion, and I also appreciate all the audience participation. We got some really great questions and had some great conversations. So thank you all.